10 years ago, in 2014, finance ministries of most Western countries were deeply entrenched in austerity measures, striving to reduce budget deficits despite high unemployment and sluggish economic growth. The current landscape presents a stark contrast. Across Western nations, economic conditions have significantly improved, with lower unemployment rates and robust corporate profit growth. Despite these positive indicators, governments find themselves engaging in heightened expenditure, surpassing their revenue intake. Today, most Western economies boast higher employment rates, robust corporate profit growth, yet find themselves spending far beyond their means. The United States, for instance, is projected to record a staggering budget deficit exceeding 7% of GDP this year, a level typically associated with periods of recession or wartime expenditure. This trend is mirrored in countries like Estonia, Finland, Italy, France, Cyprus, Greece, and Portugal, where budget deficits are widening, signaling a broader fiscal challenge. One of the primary drivers of this fiscal crunch is the alarming trend of weaker tax collections across the affluent world. In countries like America, Britain, and Japan, income taxes and capital gains taxes have witnessed a decline, exacerbating fiscal pressures. Labor market turmoil of 2023, including tech firms' layoffs, stock market downturns impacting capital gains tax collection, and fluctuations in property markets hitting the house flippers, have further eroded tax revenues, adding to the fiscal strain. The second critical factor contributing to this fiscal squeeze is increased state spending, spurred by pandemic-induced fiscal policies and interventions. Examples abound, such as financial aid for elderly care in Australia, job protection schemes in Germany, substantial tax refunds in America targeting small businesses, and ambitious green home projects in Italy. While these interventions aim to mitigate economic shocks and address societal needs, they have also fueled budget expansions, raising questions about sustainability. Following escalated conflict in Eastern Europe and a surge in energy prices, European governments earmarked approximately 4% of GDP to shield households and businesses from energy price increase. Additionally, nations like Poland and the Baltic states are significantly increasing their expenditures on defense, focusing on investments in military assets and personnel. As governments grapple with rising deficits, unsustainable debt levels loom large on the horizon. The need for fiscal consolidation has become more pressing than ever, signaling an impending shift from the era of free-spending governments towards more prudent fiscal policies. The monetary landscape is witnessing a paradigm shift, marked by the elevated interest rates, which might stay longer than originally expected. This term encapsulates the challenges confronting central banks as they grapple with the dual mandate of managing inflation and interest rates effectively, ensuring economic stability and growth. The previous year witnessed a notable disinflationary trend in America, contrasted against the current scenario of robust economic growth but persistent inflationary pressures. Recent developments have amplified these challenges, particularly with higher than anticipated inflation data in March 2024, leading to significant market reactions and recalibration of rate cut expectations. The core consumer price index, excluding food and energy costs, was expected to increase by 0.3% month-on-month but instead rose by 0.4%, marking the third consecutive month of CPI readings surpassing predictions. If this trend persists, it could solidify inflation at over 4% annually, which is double the Federal Reserve's target. In December, during a period of high optimism, the majority of investors had factored in 6 or 7 rate cuts for the year. However, they have since revised down those expectations. Shortly after the release of the latest inflation data, market sentiments quickly shifted, indicating only 1 or 2 anticipated cuts for the year, a drastic shift in expectations. The Federal Reserve's response has been characterized by a data-dependent approach, with Chairman Jerome Powell adopting a cautious stance on rate cuts despite mounting market pressures and calls for aggressive monetary easing. Now the Fed finds itself at a policy crossroads, grappling with the dilemma of whether to initiate interest rate cuts to stimulate economic growth while balancing the specter of inflationary pressures. The prevailing consensus suggests that while economic growth has remained notably robust, it seems to be reaching the constraints of the economy's capacity, resulting in sustained inflationary pressure. In conclusion, the intertwined fiscal and monetary challenges underscore the imperative for prudent policies, fiscal consolidation, and cautious monetary measures. Successfully navigating these challenges necessitates striking a delicate balance between supporting economic growth and managing inflationary risks. The path forward demands astute policy frameworks, adaptive strategies, and a nuanced understanding of the evolving economic dynamics to ensure long-term stability and resilience in the face of formidable fiscal and monetary headwinds.